Picture this. You're a 55-year-old successful executive earning more than R1.5 million a year. Life has been good. You love your job, you're part of a great team, you live in a beautiful area, your house is paid off, and your pension fund is looking healthy. But here's the catch. Your company has a mandatory retirement age of 65. That gives you just 10 years to make sure your nest egg is not only big enough to maintain your lifestyle, but also to provide true financial freedom in your golden years. You've got some cash saved, but now you're starting to ask yourself, am I saving in the most tax efficient way? Could I be growing my money smarter while keeping costs low? If these questions sound familiar, or if you think you need to ask these type of questions in the future, you're in the right place. Today I'll walk you through 5 tax-effective ways to maximize your retirement savings using practical examples to show how exactly it is done. Hello everyone, welcome to the Family Wealth channel. My name is High-dividend. I'm a certified financial planning professional and a director at Family Wealth Custodians. Please note that the information presented in today's video is hypothetical and intended for educational purposes only. It doesn't constitute personal financial advice. Each individual's financial situation is unique and it's important to consult with a certified financial planner or a relevant financial professional to make sure that you receive tailored advice that meets your unique needs. Before we start, I would like to ask you a massive favor. We have a dream of positively impacting more than 1 million South Africans through our educational videos, retirement planning and financial planning content. But we need your help to achieve this. You can help us by subscribing to the Family Wealth YouTube channel, hitting the notification button, and if you find the video informative, please share the YouTube link on your social media. Without further ado, let's jump into today's video. We all know that taxes are unavoidable, but how much you pay and when you pay can be influenced by smart financial planning. When it comes to saving for retirement, being tax efficient isn't just a nice to have, it's a game changer. Here's why. Every rand you save on taxes is a rand that stays invested, compounding and growing into your future. Over time, these tax savings can make the difference between retiring comfortably or running out of money too soon. Ask yourself, are you taking full advantage of retirement vehicles that have tax benefits like pension funds and retirement annuities? Are you planning withdrawals strategically to avoid excessive tax during retirement? Do you understand how investment decisions today affect your tax obligations tomorrow? Without a clear tax strategy, you could be leaving money on the table, money that could have been working for you. The goal of this video is to break down how tax-efficient savings can empower you to build a stronger, more sustainable retirement. By the end of this video, you'll understand how to take advantage of these strategies to secure your financial future. Let's dive into 5 powerful ways you can save for retirement while minimizing your tax bill. Okay, so in setting the scene for today's discussion, we're looking at a hypothetical scenario. So I'd like to introduce you to Bongi. So Bongi's current financial position is as follows. Bongi is 55 years old and he works as an executive at a large corporation. Bongi earns an annual salary of about 1.5 million rand. Additional to that, he earns an annual bonus of 500,000 rand a year. Bongi has 2 investments. He's got an investment in South Africa that's approximately 1 million rand, and he's got an offshore investment account that in rand terms is sitting about 500,000 rand. Furthermore, on Bongi's investments, he earns the following interest. On the South African portion of the investment, he's earning about 100,000 rand a year, and on his offshore portfolio, he's earning 50,000 rand a year and interest. Furthermore, Bongi also has a company pension fund that's currently sitting at about 5 million rand. So the big questions that Bongi has is he realizes that he wants to retire in 10 years. He wants a carefree retirement where he can really enjoy and the fruits of his labor. But the big thing that Bongi also realizes is that the 5 million rand he has in his pension fund would not be enough to sustain his current lifestyle. So how can he save for the next 10 years in the most tax efficient ways to optimize his retirement position? At the end of the day, it's not just about how much Bongi can save, but how can he save wisely to sustain his lifestyle, keep up with inflation, and ensure that there's enough for future medical expenses and unforeseen costs, all while avoiding the risks of running out of money. At Family Wealth Custodians, we help individuals like Bongi navigate these decisions in a strategic, tax-efficient retirement savings plan. Our approach ensures that every rand saved works harder for you, balancing growth and risk, and it's structured to provide financial security into your golden years. Let's circle back to Bongi's example and take a closer look at his current tax position. This will give us a clear starting point to assess how he can optimize his savings in a tax-efficient way. In South Africa, the income tax system is progressive, meaning the more you earn, the higher the percentage of tax you pay on each additional portion of income within a specific bracket. So if we look at the progressive tax tables, income tax tables for individuals in South Africa, we can clearly see that for someone earning, for example, 237,100 Rand, they're going to pay 18% tax on their taxable income. Where in Bongi's scenario, where he earns more than 1.8 million Rand a year, he's going to pay tax of about 640,000 Rand plus additional 45% of every cent or every Rand he earns above 1,817,000 Rand. Coming back to Bongi, how does this apply to him? So if we take Bongi's scenario, we can see that Bongi earns a salary of 1.5 million Rand. His bonus is 500,000 Rand. He earns interest income of about 150,000 Rand a year, but he gets the annual interest exclusion of 23,800 Rand. That means the taxable interest he earns is about 126,200 Rand a year. That means that his total income is sitting about 2,126,200 Rand, but he makes a 10% contribution, which sits at 150,000 Rand to his pension fund every year. And that amount is, of course, tax deductible. So if we deduct the 150,000 Rand pension contribution, then Bongi ends up with a taxable income of 1,976,200 Rand. This means that the approximate amount of tax that Bongi is going to pay is sitting at about 716,128 Rand. Now that we've calculated Bongi's current tax position, let's explore 5 tax-efficient strategies he can use to maximize his retirement savings. These strategies will not only help him reduce his current tax burden, but also help him grow his wealth in a more tax-efficient way for retirement. So the first thing we're going to explore is contributing to a retirement annuity. Over the years, I've seen many people who are skeptical about retirement annuities. This skepticism often stems from bad experiences with specifically the older products who had very high fees, limited flexibility. But here's the good news. The industry has come a long way. Modern RAs are now highly regulated, cost-effective, and have more access to world-class investment options tailored to your specific goals. In Bongi's case, he also considered maximizing his company pension fund contribution, but decided against it. Here's why. Pension funds often provide limited investment choices, while RAs allow more tailored solutions. Within an RA, Bongi can choose where the money is invested, giving him greater control over his retirement savings. So let's start by looking at the benefits and drawbacks of investing into retirement annuities. First of all, the tax saving. When you invest into a retirement annuity, 27.5% of your taxable income or remuneration is deductible. This amount is capped at 350,000 Rand per year. Furthermore, all the growth within your retirement annuity is tax-free. That means there's no tax on interest, dividends, or capital gains within your RA. This allows your investments to grow faster over time. Furthermore, diversification benefits within an RA. This gives you the opportunity to invest in a wide range of assets, including offshore investments. Unfortunately, that's limited to Regulation 28, and other asset classes like equities, bonds, and cash. The drawbacks of investing into a retirement annuity are the following. First of all, limited access. You can only access your funds at the age of 55. And then you can only access 1/3 of your portfolio as a retirement lump sum withdrawal, and the rest of the portfolio needs to be commuted to a living or life annuity. Furthermore, you are limited to Regulation 28. That means you can only have a limited amount of exposure to growth assets. After carefully evaluating his options, Bongi decided to contribute an additional 200,000 Rand to a retirement annuity, bringing his total retirement contributions to the maximal allowable limit of 350,000 Rand for the year. While he's already contributing 150,000 Rand to his company pension fund, this additional RA contribution not only reduces his taxable income significantly, but also ensures his money grows in a tax-free, cost-effective, and disciplined manner. By leveraging both his pension fund and RA, Bongi is maximizing his tax benefits while setting himself up for a more secure and well-planned retirement. The next strategy we're going to look at is contributing to a tax-free savings account. This is a great tool that I recommend to all my clients, even those with very large portfolios. A tax-free savings account is one of the simplest ways to save in a tax-effective and cost-effective way for retirement, regardless of your income level or portfolio size. With no tax on interest, dividends, or capital gains, these products provide an outstanding growth potential over the long term. So let's look at the benefits and drawbacks of investing into a tax-free savings account. First of all, there's no tax on growth. Contributions of up to 36,000 Rand per year with a lifetime limit of 500,000 Rand allow you to get all your returns, including interest, dividends, and capital gains, to grow completely tax-free. Furthermore, it provides flexibility because funds can be withdrawn at any time without penalties. Now, I won't recommend that you withdraw your funds because this is a great tool to use for retirement, but you have the options that if you need funds, you can withdraw the funds. The tax-free savings account provides you with a lot of diversification benefits because within tax-free savings accounts, you can invest into offshore instruments, ETFs, money market accounts, and a various array of different products and vehicles to attain the maximum growth. So let's look at the drawbacks of a tax-free savings account. First of all, the contribution limits. There's an annual cap of 36,000 Rand per year. Now this may feel restrictive, especially for someone like Bongi who earns a high income and wants to invest more. Furthermore, there's a loss of contribution room. Any withdrawals permanently reduces the available lifetime limit, so withdrawing funds early could impact your long-term growth. After evaluating his options, Bongi decided to contribute the full annual amount of 36,000 Rand to a tax-free savings account. He sees this as a simple, cost-effective way to grow his savings tax-free while maintaining the flexibility to access funds if needed before retirement. Often clients, especially those with larger portfolios and high incomes, ask if contributing to a tax-free savings account really makes a difference. To answer this, I like to provide this example. Should you contribute the maximum of 36,000 Rand per year for 14 years, that would be the lifetime limit of 500,000 Rand, and your tax-free savings account grows by 10% per year, your account could grow to approximately 1.4 million Rand at the end of the period. At retirement, this could provide an additional tax-free monthly income that you can withdraw without affecting your taxable income or pushing you into a higher tax bracket. So to answer the question, it's definitely worth your while. The third thing we're going to explore is investing into a South African endowment. A local endowment is a tax-efficient long-term savings vehicle designed to simplify tax management while providing disciplined savings and estate planning benefits. In South Africa, the insurance company managing the endowment pays a flat rate of tax of 30% inside the investment, which includes interest, rental income, and capital gains. This makes an endowment particularly advantageous for high-income earners with a marginal tax rate of 30% or higher. So how does an endowment work? Tax on interest and rental income is capped at 30% within an endowment. The effective capital gains tax for an endowment is sitting at 12%. And then what's important is tax is withheld at source by the insurance company, and the proceeds are actually paid as an after-tax amount to the investor. The investment term of an endowment is currently sitting at 5 years, during which you have limited withdrawal and you're restricted. This encourages disciplined long-term savings. Furthermore, there's a clear estate planning benefit, since beneficiaries can be nominated to receive the proceeds directly, bypassing the estate. This reduces delays and avoids executors' fees. You're still going to pay estate duty, but at least you know you're going to save a substantial amount in executor fees. For this example, Bongi decided to invest 500,000 Rand into a local endowment. Here's how this benefits him. First of all, assuming an annual return of 10%, the tax on the investment is capped at 30%, which is significantly lower than Bongi's marginal tax rate of 45%. Furthermore, the effective capital gains tax within the product sits at just 12%, reducing the impact on long-term gains, since Bongi's marginal or capital gains tax will be taxed at 18%. At the end of the 5-year term, Bongi receives the proceeds as an after-tax amount, simplifying his financial planning. By nominating his spouse as the beneficiary, the funds bypass his estate, avoiding delays and executors' fees, while ensuring his family benefits promptly. By including a local endowment in his financial plan, Bongi is leveraging the tax advantages, estate planning benefits, and disciplined saving structure of this vehicle. While the lock-in period and potential fees are consideration, this strategy adds diversification and tax efficiency to his retirement strategy. The fourth strategy we're going to look at is investing in an offshore endowment. An offshore endowment is a tax-efficient vehicle that allows individuals to grow their wealth globally while benefiting from a reduced tax burden. This is an excellent option for high-income earners like Bongi who want to diversify their portfolio internationally and gain exposure to foreign markets while enjoying the estate planning and tax management benefits. So how does an offshore endowment work? First of all, similar to a local endowment, the tax on returns, interest, dividends, and capital gains is capped at 30% for individuals. The effective capital gains tax rate is 12% within the endowment. The tax is withheld by the source, by the administrator, and the investor receives the proceeds as an after-tax amount upon maturity. The global endowments provides global diversification by allowing you to invest into foreign currencies, assets, and markets. From an investment term point of view, offshore endowments also has a minimum term of 5 years, which encourages long-term savings and financial discipline. And when you look at estate planning, beneficiaries can be nominated, avoiding executors' fees and reducing estate delays. For this example, Bongi decided to invest the 500,000 Rand he has in his offshore account into an offshore endowment. Here's how this benefits him. Assuming an annual return of 10% in foreign currency, the tax on investment growth is capped at 30%, much lower than Bongi's marginal tax rate of 45%. By including an offshore endowment in his portfolio, Bongi is enhancing his global investment exposure while benefiting from tax efficiency and estate planning advantages. Though it requires careful consideration of fees and currency risks, this strategy provides diversification, disciplined savings, and a tax-efficient growth, making it a valuable component of his overall retirement plan. Strategy 5. Investing in a unit trust focused on high-dividend income funds. A unit trust focused on high dividend income funds is an investment vehicle that generates regular income through dividends, while offering the potential for long-term capital growth. This type of investment is particularly appealing for individuals like Bongi who are looking for a tax-efficient way to earn passive income while diversifying their portfolio. So how does it work? High dividend income funds invest primarily in stocks that pay consistent and substantial dividends. Dividends are subject to dividends withholding tax at a rate of 20%, which is lower than Bongi's marginal tax rate of 45%. Furthermore, when we look at capital growth, in addition to dividend income, the underlying stocks in the unit trust may appreciate in value over time, thus contributing to long-term capital growth. For this example, Bongi decided to invest 250,000 Rand in a unit trust focused on high dividend income funds. Here's how this benefits him. With an expected dividend yield of 8% per year, Bongi could earn up to 20,000 Rand annually in dividends. This income is subject to dividend withholding tax at 20%, meaning that he retains 16,000 Rand as an after-tax income. The underlying assets in the fund may also grow in value, providing potential for capital appreciation over time. This investment is fully liquid, allowing Bongi to withdraw his funds if needed, giving him flexibility alongside the other benefits of such a structured savings vehicle. By including a unit trust focused on high dividend income funds in his portfolio, Bongi is diversifying his investments while earning a tax-efficient stream of passive income. This strategy adds liquidity, stability, and growth potential to his retirement plan, making it a smart complement to his other tax-efficient investments. So if we now come back to Bongi's position and we look at his post-implementation financial position, we will see that Bongi is still earning a salary of 1.5 million rand a year plus the bonus, but now with the restructuring of his portfolio, he now has 500,000 rand sitting in an offshore endowment, 250,000 rand sitting in a unit trust earning dividend income, and he has 250,000 rand just in a normal unit trust fund and 500,000 rand in a South African endowment. So what does that mean? That means that he's earning about 25,000 rand per year in interest from his unit trust. From his offshore endowment, if we assume that he's earning 10% growth, that means he's earning interest. That means he's earning 50,000 rand a year from interest from his offshore endowment. From his South African endowment, he's earning a further 50,000 rand per year. And from the dividend-focused unit trust fund, he's earning 20,000 rand per year in dividend income. And he still has his company pension fund to which he's contributing to. Circling back to Bongi's tax calculation, let's look at what his scenario is going to look like after implementation of the recommendations as discussed. So first of all, if we look at Bongi's salary, his salary is going to stay the same at 1.5 million rand. His annual bonus is going to stay the same at 500,000 rand. His interest income, he earns about 25,000 rand from his high interest or high income unit trust fund. But he gets the 23,800 rand annual interest exemption. That means only about 1,200 rand will be included as a taxable income. Furthermore, so that means his total income is sitting about 2 million rand, but then we need to consider that he makes a contribution of 150,000 rand, 10% of his salary, to his company pension fund, and over and above that, he's contributing a further 200,000 rand to a retirement annuity. That means there's 350,000 rand that he is contributing towards tax-deductible retirement savings. So that means his total taxable income for the year is going to sit at about 1,770,000 rand. So what does that mean? That means his income tax for the year is going to be 625,000 rand. And the tax inside the endowment, if we assume that he's earning interest on both his offshore and local endowment of about 10%, and so that's 100,000 rand taxed at 30%, ends up at about 30,000 rand of tax in his endowment, and then a dividend withholding tax on his high dividend unit trust fund is going to be about 4,000 rand. Again, he won't necessarily pay that, will be withheld by the company paying the dividends, but just to illustrate the example, that means an approximate total tax of about 659,218 rand. And what does that mean? That means just by implementing this scenario, his annual tax saving on his investments and his income is going to be about 56,910 rand, which is a substantial amount of money just by restructuring his portfolio into tax-effective ways. Everything we discuss and analyze with clients is just a snapshot in time. Each year, circumstances change, portfolio values fluctuate, tax laws change, and spending patterns vary, and personal goals evolve. Staying connected and regularly updating your retirement plan is essential. Retirement planning is not just a one-time task, but an ongoing process that regularly requires adjustments. At Family Wealth Custodians, we believe in empowering our clients with the knowledge and strategies to navigate the complexities of tax planning with confidence. Whether you're just beginning your retirement journey or refining your existing plan, proper tax planning can make a massive difference in the growth and sustainability of your portfolio. Remember, the choices you make about taxes today, how you save, where you invest, and when you withdraw will have a significant impact on the quality of your financial future. With the right strategies and regular reviews, you can reduce unnecessary tax burdens, allowing more of your hard-earned money to stay invested and grow for your retirement. Thank you for joining me today. Don't forget to like this video, subscribe to our channel, and share with anyone who might benefit. Together, let's continue building financially empowered South Africans by making smarter tax-efficient decisions for a more secure and prosperous retirement.